So here in this video, we are going to look at this interview with this individual. He is the one that literally created the yield curve inversion as a recession indicator, and what he says I agree with 100%. Now we're also going to discuss what's going to be happening to the markets over the next couple of weeks, maybe the next couple of months, that could help you make money if you do hedge out your portfolio, if you do trade the downside price action, or if you just want to make some money. I'm going to give you guys at least my opinion what's going to be happening. I also want to go over what's most likely to happen with specifically AMC Stock. So let's go ahead and get into it. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. I hope you are enjoying your Saturday, and let's get into it.
It's now to talk rates and the latest Fed decision is Campbell Harvey. He is a professor of finance at Duke University. He also coined the inverted yield curve indicator in a 1986 thesis. And Professor, thanks for being here today. Let's talk a little bit about the inverted yield curve, because it's gotten a lot of pressure from people saying, hey, it's wrong. It's been indicating recession for a long time. You think they're misreading that indicator. What's it telling you right now? What do you see?
So the indicator is 8 out of 8 in predicting recessions, and it doesn't have any false signals. So one thing is the lead time from the inversion to the beginning of a recession. And if we look at the last 4 recessions, the average lead time is 13 months. So it's way too early to say this is a false signal. Maybe it does turn out to be a false signal, but you can't say it's a false signal when you're not even at the average. So at the average, we would expect a downturn to start in December or January.
December of this year or January of next year?
Correct.
Because it takes 12 to 13 months before it's going to kick in anyway, and that's about
exactly.
Where we're hitting.
And people also say, well, we've seen the yield curve inversion become less of an inversion, so kind of a re-steepening. Well, the last 4 recessions, that happened before the recession. So it doesn't mean that it's a false signal necessarily.
You think a recession is coming?
Yes. So I think that the Fed has made a major mistake. What they should have done yesterday is not just pause, but say, this is it. And indeed, it would have been ideal for them to say, well, this is it. And now the next decision is to decrease the rates, not to increase the rates. And unfortunately, there's a false narrative going on by the Fed that inflation is well above its comfort level. And it doesn't make any sense to me. And let me tell you why. The most important component, the biggest share in terms of contributor to the CPI, which is running at 3.7%, is shelter. And shelter in the calculation is running at 7.3%. And that is far away from the sort of shelter inflation in the real world in real time, where housing prices are flat or negative. Rental costs, if you look at various surveys, those are flat or negative. So if you replace that 7.3% in the CPI with a more realistic number, like 1%, which is what we observed today, 0 or 1, then the inflation is not 3.7%. It is 1.5%. And if you believe shelter inflation may be a little higher, like 2%, then the inflation rate is not 3.7%, it's 1.8%. The point I'm making is this quote unquote long way to go that we hear from the chairman, that doesn't make any sense. And I'm not talking about a special inflation gauge where you trim certain things or you throw food and energy. I'm looking at the regular, the basic inflation calculation, but replacing one very stale component with real-time, realistic numbers. And we're below 2 right now.
So you think inflation is not nearly as bad as the metrics that the Fed is watching. You think an economic recession is much closer than other numbers might suggest, or numbers that the Fed might be watching. You're a respected professor, Harvey. You're a very respected Professor Harvey. Why don't you think there's more of a traction with that picking up? Why don't you think that message is getting related more often?
People want to believe that we can avoid a recession. I actually hope we can avoid a recession. Like, nobody wants a recession. But if you look at the fundamentals in the economy, so 2023 looks pretty good for GDP growth. But if you look into the numbers, it's driven by the consumer. The consumer bailed us out in 2023, and that's a result of a lot of savings that were built up during COVID and some government help. But those savings have been driven down and are likely to go close to zero by the end of the fourth quarter. So consumption is not going to bail us out in 2024. The other important component, investment, well, that's already negative. So in 2023, investment spending, the growth rate is negative. It's almost like we're in an investment recession already. So you put those two things together for 2024, and it spells very low or negative growth. Hopefully, a soft landing.
How deep of a recession? Yeah, how deep of a recession
so
do
that's
you
the thing.
think one is coming?
The question is how deep? And every time that the Fed increases rates, it increases the probability of a hard landing. And we all want to avoid the hard landing. And it is possible to do that. And I wish that they would look at the data to understand the actual CPI and realize that in the future, that 7.3% is rapidly going to come down to something like 2%, and inflation will be within their range. But instead, they've got this one lever, and that's increased rates, and it increases the probability of a scenario that nobody wants. I do think that if we do pause and maybe start to decrease, we can avoid the worst possible case.
So what he said, I 100% agree with. Now, over the past couple of trading days now, ever since the Fed, the markets have been red. Why? Well, it's because the markets are now being forced to price in a recession again. The Fed is asleep at the wheel. They are not doing what they should be, okay? They're too focused on backwards looking data. As this individual says, they're way too focused on things that don't matter. What the Fed should be doing is trying to avoid a recession and bring down inflation. The Fed is not trying to avoid a recession. Even as Fed Jerome Powell said, the Federal Reserve's base case is not for a soft landing. They are expecting a hard landing, yet they just raised their GDP estimates from 1.1% to 1.5% for 2024. They raised or lowered their unemployment estimates from 4.5% to 4.1%. Strange. They increased their estimates for the federal funds rate by the end of 2024, basically saying they're not going to cut rates. And then their base case is for a hard landing. That just doesn't make sense. The data doesn't data. The math does not math there. So the Fed is very complicit and is the reason why we're going to head into a recession. And by the time the Fed realizes it and they do cut rates, it's going to be far too late. So if you look at the broader markets, what has happened since May is essentially the markets have unpriced the recession. Now that we know the Fed is pushing us into a recession and it's coming probably by the end of this year, if not the first half of 2024, the markets now have to reprice in a recession all over again. And that's not a fun thing to go through. And that's what we've seen recently. And I do think there's more pricing in of a recession to come because markets are forward looking. So markets sit here and say, hey, if a recession is 3, 6, 9, 12 months away, really 3 to 6 months away, the markets start to price that in now. So think about it like out of 100%, right? If you have 0 being no recession, 100 being a bad recession. The markets on that 0 to 100 need to price that recession in. Now, let's say your ultimate outcome is 100%, a bad recession. Well, the markets, they're not going to fully price in a bad recession before you go into a recession, before the data actually looks like a recession. But when you have signs that are this strong that we're going into recession, in which we go over them all the time, the yield curve being inverted, the personal savings rate being at the lowest point it's been at basically ever, because people are just spending too much money. They can't save money because the cost of living is so high. The auto loan delinquency rates being at higher levels now than they were during the great financial crisis. Student loan repayments coming due on October 1st. That's going to have a net drag in the economy of about $15 billion. You also have the UAW strikes, the writer-actor strikes that have been happening, the surge in oil, about 35% within the last couple of weeks here. All of these things are very recessionary, and it's going to be very hard to avoid a recession if that's even actually possible, which it doesn't seem like it to me. So the markets, again, out of that 0 to 100, they might price in about 50% of that recession before you actually get to that recession. Because markets are sitting here saying, hey, there's a big chance we go into recession. So that's where you could get the sell-off down to about 400 on the S&P. Now, after that, or potentially lower, it really depends on what Q3 GDP is October 26th. It depends on what earnings are for next quarter and what companies have to say. All of that will be important. Non-farm payrolls, weekly unemployment insurance claims, all of that will start to matter a lot more, but you're only going to price in so much of a recession before it actually happens. So I do think the downside to some degree is somewhat limited. 400, 380 on the S&P in that range could be appropriate to reprice in a recession. Again, once the recession actually starts or happens, then the question is, then the fear really is, how deep is it going to be? How long is it going to last? And that's where you get from 50% all the way to 100 as far as pricing in this actual recession. So right now you're in the first innings. You're in this first inning stage of, markets now realize we're going into recession. We got to price that in. That means, like I said, 400, 380 on the S&P is likely, in my personal opinion. That's not like a worst case scenario. That is likely, in my personal opinion. It likely does take a couple of weeks, maybe a month or so, to get down to those levels. And again, data, all of that will be very important. And then, subsequently from there, it's what does the data look like? When do we actually go into this recession? That is then the biggest question. So that's kind of what I'm looking at here. I do think you're actually going to get that final drop, maybe back to your October lows, maybe a little bit lower by the time you enter into that recession, which is some point in the beginning of 2024. So right now, it's probably a great idea to be saving some cashola. Now, in terms of AMC stock, I do believe in this first inning, you already have priced that in with AMC stock. There's no exuberance here with AMC share price today. You likely hit that low around $7.05 per share. Now, in that second inning, that last 50%, that's where you could see AMC stock fall to maybe $5 per share. That would be a good level, maybe $4 per share, if we were at these same current prices, right? If AMC stock is $10, $15 by the time we go into recession, well, obviously that downside is going to look a little bit different. Maybe not going to be so bad, but if we are the same price today heading into that last half of the actual recession and pricing that in, then you could fall maybe to $5 per share. But what's the beautiful thing about AMC right now? You've hit that low at $7.05. You have priced that in. The worst has been priced in already. I do not believe AMC stock is going to break under $7.05 per share anytime soon. I could be wrong on that. Something could happen and the markets could freak out and panic. That's obviously a possibility, but I just don't see much downside from here. I think the risk to reward looks very, very good with AMC stock. So that's going to do it for this video. I don't really have too much else to add. You're at the lowest levels you've been since ever really on AMC stock in recent times. You're lower than January of 2021. So it does look very appealing to be an investor in AMC. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comments section. If you guys want to come trade with us live in real time, come hedge out your portfolios, all of that link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.